there's different kinds of bank accounts. You know, obviously you guys have heard of checkings and savings, but there's a bunch of different other kinds of bank accounts that you can have. The checking account is a bank account that allows you to make deposits, withdrawals, and transfer funds. Not every account allows you to do that. Okay. With a checking account, you write checks. Well, not so much anymore, but still some people do write checks. And the check is a written order telling the bank to pay money to the check holder. An electronic funds transfer is, you know, in terms of banking, relatively new. They came about, you know, once we had computers. And it moves funds electronically from an account in one bank to an account in another. And this process is much faster. If you write a paper check, let's say to a store, then they take that check that night and they deposit it into their bank account. And then their bank processes it and then sends the request for money to your bank, and then your bank processes it and then sends the money to their bank, and then their bank puts it in their account. And that can take a few days. If you mail a check to somebody, it can take even longer because you have to wait for the mail to get there, and then they get the mail, and then they go through that whole process. An electronic funds transfer can happen instantly. Yeah. So just, you know, be aware that there's not necessarily a buffer when you do electronic funds transfers. The payee is the person that gets the money, and the drawer is the person that's paying the money. Questions on any of those? Okay. When a check has cleared, that means, like, if I write a check and then it has cleared, that means the money has already come out of my account and gone to the other bank. So a check clears when you have enough money to cover the amount of the check and it's been paid. The opposite of clearing is when the check bounces, when there's not enough money.
Is the deposit slip like that thing at the bank where they...
I put a question mark on not paid because that depends. Your check might bounce because there's not enough money, and it may or may not get paid. It depends on what account you have. Some accounts have overdraft protection, and so maybe you have money in your savings and they'll take the money out of your savings to pay the check and charge you a fee. Or maybe they just pay the check and let you go negative and charge you a fee. Or maybe they don't pay the check and they charge you a fee. Do you notice a common theme here? Fee. Whether you have overdraft protection or not, if you don't have enough money to cover the check, you're getting charged a fee. Okay? The deposit slip, like a lot of accounts, they don't require you to even put a deposit slip anymore, but some accounts do. Like Wells Fargo, I know that if you go to the drive-in teller and you put a check deposit in through the drive-in teller, you do have to have a deposit slip still. Some banks don't.
You walk right in.
But who wants to go in the bank? Okay, so it's a slip of paper that you fill out. You list cash, and then you list individual checks. You have to list each check individually, and then you do a total. It says how much money. And it's nice because that way the money does go into the account number that's printed on the deposit slip. Direct deposit is what most people have now. These are electronic deposits. Usually it's paychecks or government checks like tax returns and things like that, Social Security. So direct deposits are electronic deposits. So let's say I'm your company and I'm going to do a direct deposit paycheck for you. I submit the order for the direct deposit. The bank that receives it, so your bank, validates it to make sure I have enough money in my account. So there's like signals that go back and forth between the two banks. Only after it's been validated do the funds become available in your account.
So is that like you can put like a check for an
No, this is direct deposit. Like you can sign up for a direct deposit when you get your paycheck from certain companies, and they deposit your paycheck directly into your account for you. if you're on Social Security or disability, or if your tax return, you can have all of those put into your bank account for you automatically. A hold. Holds are put on checks that you're depositing until the check clears. So usually the criteria for having a hold put on the check is a large check. Like if you go in, let's say, grandma writes you a check for $3,000 for some apparent reason, and you take grandma's check into the bank and try to deposit a $3,000 check, the bank is going to put a hold on that until the check has cleared, because it's a large amount and it's a personal check. Holds could be from out-of-state checks, regardless of the amount, because it's coming from out of state, they might put a hold on it. Any reason that they feel like they need to put a hold on a check to make sure it clears before they give you access to the money. Because if you deposit the check and it's not a good check, and then you spend all the money, then the bank is out money.
And it's fraud.
Yeah, and it's fraud. So they put a hold on the check.
Couldn't most that only take like a couple seconds though?
No, not necessarily. Usually holds are 3, 7, or 10 day, generally. And then endorsing a check is you are going to physically handwrite on the back of it. You can use a stamp, like a for deposit only with the account number kind of stamp, or electronically. If you're talking about direct deposit and stuff, those are electronically signed. You do that to the back of the check to be cashed or deposited. If you try to deposit a check that has not been signed, it gets rejected. So when you have direct deposit, that paperwork you fill out is your electronic signature. So it's being electronically endorsed.
With no overdraft.
Yeah, so like if you have no overdraft protection and you wrote me a check for $100 and you only had 50 in your account, that would depend on your bank. Your bank may choose to go ahead and let me have the $100. They'll make your account negative 50, and then they'll charge you another fee on top of that, usually about $30 to $40, and now you'll be negative, let's say, 90. Or they might say, no, sorry, that check bounced. They'll return it to my bank. I'll be charged $25 fee for your check bouncing. You'll be charged a fee for your check bouncing, and now you'll have like $20 left in your account, and I won't have the $100. And it have cost me $25.
So they can't just like give you that and like wait until the person.
Not if I have deposited it into my account, no. Now, if I go into your bank and try to cash it, they might just hand it back to me, or they might keep it because they might consider it to be fraudulent. It depends. Once you've cashed a check or deposited a check and it's been paid, it's called canceled. And they have, you have your account number and your routing number and stuff on the bottom of the check, and then there's also the check number in the top corner. They keep track of all of that so that you can't deposit or pay with the same check more than once. The insufficient funds, like I said, how your bank handles it kind of varies how they handle things. Usually if you're close to having enough money for the check to clear, like you're within $10 or $20, they'll go ahead usually and pay it and then just charge you the fee. If you do it a lot though, they'll stop doing that and then they'll start bouncing them and sending them back.
They charge you like the difference or like an extra?
They charge you, let's say you wrote a check for $100 and you had $80 in your account. They'll go ahead and pay the 100, which means you're now negative 20. Then they'll charge you a fee on top of that. So if it was a $30 fee, you're now negative 50. And then some banks do what they call extended insufficient funds. So let's say you don't have any money to put in your account for the next week or two. After a certain length of time, they'll start charging you per day that your account is negative. That's usually a smaller amount. It's not $30 a day. It's like $2 to $5 a day. But that adds up really, really fast. And it becomes a big hole to dig out of.
So try to have like a minimum of like $5 in your
No,
account.
it's like 100 or something.
It depends on the bank. It depends on the bank. The ATMs give you 24-hour access to withdraw and deposit money. However, usually you can only deposit money at your own bank's ATM. Like I can't, if I have an account at Chase, I can't go to Bank of America and use the Bank of America ATM to deposit into my Chase account. But I can withdraw. And there are fees charged, usually if you use a different bank's ATM. So I don't know if any of you ever use the ATM at a 7-Eleven? Anybody? Because what happens there is they'll say, you know, this is going to charge you a $2.50 fee, and you agree or you don't agree, and usually you agree because you need the cash, right? So your $20 withdrawal costs you to $20 out of your account that you took out, plus the $2.50 that ATM charges you, plus the $1.50 to $2.50 that your bank charges you. So that $20 actually takes $25 out of your account.
So even if you go to the ATM from your own bank?
No, if you go from your own bank, there are no ATM fees. It's when you go to the other banks that you can get charged from both banks. Or, you know, go someplace where you don't need cash and you can just use your debit card. Maintenance fees. Account maintenance fees are monthly fees that are charged in certain types of accounts. The amount varies based on the bank and the type of the account. Interest is a percentage of the money in your account over a given period of time that is paid to you, the account holder. Most checking accounts do not have interest, do not pay interest. It's usually the savings, money market, CDs, those type of accounts that pay interest. Checking accounts generally don't, but there are some that do. Your basic checking account is the most popular type of account. If you have a checking account, this is probably what you have, is a basic checking account. You can move money at will. There are no, some types of accounts have limits on the numbers of transactions you can have in a month, but in a basic checking account, there's no limits to the number of transactions. You can put money in, you can take money out, whatever. There are low or no minimum balances. There's no interest paid, and then there's low or no monthly maintenance fees. Okay. Like I know some basic checking accounts require $100 to start them, but you don't have to keep $100 in them. Interest-bearing checking accounts pay interest. Usually that's monthly that they pay you the interest. They do have minimum balances required. They're usually a little on the higher side, so they may have a $500 minimum balance, which means you have to keep $500 or more in your account at all times. If you go below that minimum balance, you get charged a lot of fees, and you lose your interest for the month. So, you know, just if you get an interest-bearing checking account, just make sure you've read all the fine print and you know all the fees and things that if you go below your minimum balance. Free checking accounts have no minimum balance and no monthly maintenance fees. People get confused and think a free checking account means there's no fees at all. You can still get fees for ATM transactions or insufficient funds, things like that, but you don't have monthly fees that are, you know, you get charged the same amount every month. The Federal Truth in Savings Act protects these accounts. So if your bank tells you it is free checking account, and then they come back and go, well, you know, except if you don't have $20 in it, and then it costs you $10 a month, they're violating federal law. If they advertise the account is free, there cannot be monthly fees, period. They can, like I said, they can charge ATM fees, they can charge insufficient fund fees, but they cannot charge you any kind of monthly maintenance fee. It's very important to know. Okay, a joint checking account is an account owned by more than one person. You can have several people on an account. You have equal access to the account, and you also have equal liability. So if you and 3 of your closest friends all have an account together, everybody has equal access to the money no matter how much each person put in. And if one of these friends goes and runs up a bunch of insufficient funds, fees, and everything else, you're all equally responsible for them, even if you didn't all do it. Express checking accounts, these ones you want to be careful of too. You are supposed to access them electronically only, so phone, computer, or ATM. If you actually talk to an actual person at these banks with an express checking account, you get charged money. So if you walk in the bank and talk to a person, they charge you money. If you call on the phone and talk to an actual person instead of the automated system, you get charged money. Yeah, it is. I don't know. Okay, we will continue this tomorrow.